Welcome to For the Record. I'm Eric Schatzker. Barry Sternlicht made his name in real estate at the age of 32 after starting a fund to buy cast-offs from the savings and loan crisis and almost doubling his partner's money in 18 months. Sternlicht is 49 now, and he's done a lot since. He even created the Starwood hotel chain. But ask Sternlicht what he makes of today's mess in real estate, the plunging home prices, the emptying office towers, and he'll tell you there's never been a better time to invest.
Get things done when the markets get out of whack, which they're doing as we speak. You can get things done quickly, privately, with very few bidders. People come to you for certainty, and they come for you for speed of execution because they have to get something done. They have to pay back a loan. They have to sell something quickly because they've got to fund another obligation they have. And what that means and why that's interesting is you can earn excess return too. You can earn a great return for modest risk. And when there's asymmetry between more upside than there is downside, that's the markets we like to play in.
Does it become more of a buyer's market?
Over time, but most markets like this are characterized by guys who remember the values 18 months ago or 2 years ago. And they knew they turned down that bid for $200 million for that office building. And today the building's worth 60. Probably, but they don't want to admit it. So they hold on quarter to quarter. You're saying it's worth 60. Is there, we want 180. It's worth 60. We want 120. It's worth 60. We want 90. And they call us, as one of the banks did 2 days ago, and said, okay, we'll take 60. And we said, well, that's great. We'll be there tomorrow. And we'll tie it up in a day. We know the asset. We know the market. We've been there doing this a long time. And we wait for those phone calls, and they come only in markets like this, only when people don't have time. We're not the lowest cost of capital. Now we may be the only capital.
Rewind the clock 2, 3, 4 years, and it's hard to believe the deals that were getting done and the prices they were fetching. Fairmont Hotels, $3.5 billion. Extended Stay, $4 billion. Hilton, $19 billion. Eventually, Barry Sternlicht just stopped trying, and he might have stayed on the sidelines had certain conditions not changed.
I mean, I started an energy group, a securities group, because I thought risk and reward had gotten kind of way out of whack. I mean, there was a little bit of reward and lots of risk. And pricing was being driven by the lenders who were able to sell off the debt. So prices were zooming up. And it wasn't the market I had started my firm in. The biggest difference today and 2 years ago, you can buy real estate at deep discounts to replacement cost. Prices had risen to the point where land prices were soaring in Manhattan. They went from $100 to $500 a foot just for the land. Construction costs were going out of control. And, but rents were rising, so it still was sort of working. Now the whole thing's gone in reverse.
But you didn't believe it, or did you?
Commercial real estate, I didn't believe it. I didn't believe that buying office buildings at 3% yields and 4% yields and financing them at 6%, meaning you have negative leverage.
Negative spread, right.
Negative spread. I departed from some of my peers in real estate, and we put our money where our mouth is. We invested $2 billion of equity in 2005 and $700 million in 2006 and only $180 million in 2007. And we stopped buying. This has been a take no prisoners correction.
What about all those real estate transactions that were done during the boom years with big leverage? Hilton, Extended Stay, Fairmont, any of those names. What happens to those transactions?
You got a long list because we bid on all of them and lost them all. And their equity is, I would say, yield to death. You're going to go bankrupt. And they may have a chance to buy in the debt and restructure their deals. But for the most part, there isn't a piece of commercial property in the United States that's not down more than 10%. So most of us, if we have more, even if we had an 80% levered deal, or 70% leverage deal. By the way, you couldn't buy anything unless you levered 80% because there was a guy who was willing to go to 90%.
Right. Cost of capital. It was all cost of capital.
It was all willingness to take on that leverage, how aggressive you're going to be with the underwriting of the rents going forward, and to some extent cost of capital. But guys were making a lot of money. They're buying a deal 90% levered to a 17, selling it to a guy who wanted a 14, selling it to a guy who wanted an 8. And because they had very little equity, they were making very good returns.
But you had to flip it.
It was musical chairs. And the music not only stopped, as I say, the orchestra left the room.
Blackstone Group CEO Steve Schwartzman had one more deal left in him before the leveraged buyout bubble burst. Hilton Hotels at $47.50 a share, or almost a cool $20 billion. Now Hilton's on shaky ground, and it makes for some uneasy conversations when two real estate moguls get together to talk shop. What do you and Steve Schwartzman talk about when you talk about that deal? Because that was the last big leverage deal done in real estate.
I looked at buying Hilton many times when I was running Starwood Hotels, and you know, we couldn't get to that price. They did something very smart, Blackstone. They were able to, they financed floating. So while the operating performance is coming down and probably...
So are the interest rates.
So are interest rates. So there's a hope certificate. They have a breathing room. I mean, right now, if you had to sell it, they'd agree their equity's worth nothing. But 4 or 5 years from now, unclear. It's one of the deals that I could see having some value someday.
What happens, though, to the loans that are defaulting? We just saw, for example, the John Hancock Tower in Boston.
Yeah. One of the most aggressive buyers in the country bought that building. And really, that was the poster child for the period of time we went through. But it was definitely, you know, the musical chairs. We'd get calls from banks. We'd say, send us the book. I was just reviewing the loan books from a conduit, one of the conduits that the banks formed. Mm-hmm. And we got 40 files from them on one of these loans. 30 of the files had nothing in them. There was, like, no due diligence. I mean, and they sold it off. I mean, they originated them, sold them. And, you know, it's interesting because they never understood the markets.
What does it mean to bottom fish in commercial real estate these days? How much risk do you have to stomach? How long till your bets pay off? Where should you be buying? I asked Barry Sternlicht.
You have to invest over a different time period today. If you're really honest with yourself, in my opinion, commercial real estate, that would be office, retail, shopping centers, malls, or industrial buildings. Those major asset classes in real estate, I don't think you'll see income growth for 3 or 4 years. It's actually not a question of growth in rents, which we were underwriting. Now it's a question of how far they'll fall. And the stability of the tenant. Will the tenant be there to pay you the rent that he's supposed to pay you in that building? And what you try to do is find positions where you can make it through this 3-4 year trough. When you know that over time GDP will increase, demand will increase, there won't be any new supply, and so the markets will begin to absorb and the cycle goes on. New York will not be as tight as it was in 07, 06, maybe even the beginning of 08. Could be a long time, could be a decade.
What else? What other cities face that kind of potential future?
Washington, D.C. Expansion of the government is really good for
financial
estate,
capital of the world.
Financial capital of the world. I think the equity markets will be fine over time. I think Boston would be okay. There are certain markets in the United States that are just trading markets. They have no barriers to entry. You know, the cities like Houston and Dallas, if anybody could get the money, they can build anything anywhere. Then there are investing markets like Boston, New York, Washington, San Francisco, where they're environmentalists. It's difficult to build. They give you all kinds of grief. Boston. We own our building, and it's leased to the state, and we earn a very good return on our investment. We just wait.
Okay, so we talked for a moment about the potential for a turnaround eventually in the commercial market, but between now and then, where's the trough? How much worse could it get?
How much worse could it get? For commercial real estate, you're hearing it from everyone. The real estate horizon is filled with multiple landmines. Every time one of these loans matures, it's going to
set up a chain reaction.
Yeah, if it's in a CDO or it's in a
CMBS.
Every one of these trades, and as these things resolve, all the information is going to roll through the markets, and people are going to extrapolate from whatever happened on that deal.
Reprice on the basis of this.
Exactly. What we're trying to do today is buy debt. You know, because the debt will pay you a yield today, and it'll probably mature in 2011, 2012, 2013, and that will be the day of reckoning. Almost every piece of commercial property will be able to carry the mortgage until the day of reckoning when it matures. And when it matures, we'll find out if you were going to get paid off, or you're going to own the property, or you're going to have a negotiation. So you've got positive leverage, because the only leverage you can get today has to cover. You have to have debt service coverage. And you can buy deep discounts for replacement costs. Those are two of the ingredients you need to make money in commercial property. The third, though, is you need absorption. You need markets to tighten. You need an economy to come out of this. And so I think in certain markets the bell is going off. I think we could talk about the residential markets, and I think you are seeing a bottom forming in many of these residential markets. Yeah.
Where in particular?
The tri-state region where we're sitting. California, Florida, Arizona, the markets that really started to fall in late 05, 06, that have now fallen 50, 60%. I think those markets are beginning to bottom, and maybe bottom.
But selectively, because some people say prices could fall another 20%, but he's speaking nationwide.
We think macro and invest micro. So, in those, we love that because everyone runs for the hills.
A lot of people might be overjoyed, frankly, to hear you say that you think a bottom is forming in residential real estate. But does that mean you're rushing in to buy now?
Well, we're bidding on land. We have a venture with 8 former home building executives that cover the growth markets for us. We're losing a lot. So, it's, I think we're more negative on the recovery. If you're trying to earn 20% returns, you can't get any leverage at all on land.
There's no income.
There's no income. And he who thinks the world's going to ratchet back the fastest and the furthest wins. So I don't know if we're wrong. I think the big negative for home building is clearly unemployment. And having said that, unemployment is 23% in Detroit, but it's 4.5% or 5% in New Orleans. I mean, you can look at the big stats. The opportunity comes from the little stats and what city's really absorbing homes fastest and what's most affordable.
But you like the markets that have fallen the furthest, Florida, for example, Phoenix, Central California. Is that where you think the opportunity exists right now?
Well, that's where we're looking. In Texas, the Carolinas. One thing that's important in investing is if you can get bailed out by growth. If you're creating 1 million households a year and 70% of them buy single-family homes, that's not going to Detroit. I mean, all that
kind of matters. Right,
kind of at St. Louis. I mean, Springfield, Massachusetts. There isn't huge demand for single-family homes today, because there would be in a normal market, guy moving out of his 30-year-old house to a new house, but he can't sell his 30-year-old house. I think the new calculations in the home market are going to be the fiscal status of the state, because the states will try to raise property taxes as they're doing. New York City just had a whopper. California is going to increase taxes. I think people, and you've had a funny market because normally people just move to the states that are cheaper. They leave their home in Detroit and they go to Florida, leave their home in Massachusetts and they go to Texas. They leave California and go to Phoenix. They haven't been able to sell their house. So people are stuck and they can't move. So the markets are all sort of screwed up. But this too will pass. The U.S. creates 1 million something households a year, and has for 20 years and will for the next 20 years. And that will create demand. So, and I like to tell my guys that in the home building space, it's a question of when you'll make money, not if you'll make money. You will make money.
The Public-Private Investment Program. It's what the government's counting on to clean up bank balance sheets and get credit flowing again to real estate. But for the PPIP to work, it's going to have to appeal to investors like Sternlicht.
I think the government's making a huge mistake not hurrying up for real estate, because these bombs have exploded or begin to really set off. People will panic. I mean, the insurance companies have gazillion dollars of this stuff. And if the rating agencies do what they will likely do is now they'll be overly aggressive downgrading paper. These insurance companies will blow all their regulatory covenant, and they will be a basket case. And these are big. The insurance companies are big. And, the MetLives, I mean, they have a big property book. GE, big property book. The government financing, everyone's nervous about the long tentacles of the government and how intrusive they're going to be. But I think we're all waiting to see the rules of engagement here. What I don't want to see is them picking 5 big boys and letting them collude and price the market. And that's just a calamity and a joke. The government did one very smart deal, actually, and the press didn't really cover it. They liquidated 2 banks in Nevada and Arizona, and they formed a loss sharing with the equity sponsor, us, and other guys that bid. And the deal was the government put up 80% of the money, you put up 20% of the money, and after the government got, let's say their account was worth $100 million, after they made $100 million, you got 20% of their profits. I actually thought that was the brilliant structure. They got 15 bids, which must have surprised them on this stuff. And we bid. And why that was interesting is because they were in equity. They got their $100 million plus $100 million. We, the private equity guys, sweat equity, work it out for them, work the portfolio. After they got their $100 million, you got 20%, they got 40%, you go 80-20 on their money. So we're working, our new partners, the government, interests are nearly totally aligned. And I thought that structure was fabulous, and I think a better structure than what they've come up with.
Than the PPIP.
Absolutely.
Of course, the PPIP isn't the only helping hand being extended to banks. There's also the Tarp, plus federal guarantees for commercial paper and bond obligations, even if some of that money is getting used to finance private equity deals.
JP Morgan and Wells and B of A, they don't do this. Right? They never were in the business of raising private equity funds, not never. They got out of the business. For Goldman Sachs and Morgan Stanley to continue to compete with not only TARP funds directly, which they'll pay back because the government helped them through this, but then they issued bonds, 15 billion of bonds backed by the government, and they can continue to do that. They borrow at quasi-government rates, and then they compete with us. That's just in GE with the commercial paper, and they can compete with the little guy. It's practically un-American. So, I mean, I mean, we didn't cause any mess to anybody. Why are we suffering and competing with government-sponsored funds, basically, against ourselves?
But what's the alternative?
The government needs Goldman Sachs and Morgan Stanley and the other bank holding companies. They're supposed to be a bank now to take risk and to make loans. Okay, if I'm Goldman Sachs, I should be writing that loan on the commercial deal. I should be selling the AAA piece to the government-sponsored fund, and I should take the mezzanine loan, the whole. That is what the mortgage markets and the United States needs. We need lenders to make reasonable loans and the banks to hold the piece that they can't sell off into the AAA market, supported by a government credit. That would, the cost of funds with a AAA guaranteed by the government and the mezzanine held by JP Morgan and Wells Fargo and Regions and PNC, that is the only thing that's going to get this market moving again.
When investors talk about real estate, they talk in terms of capitalization rates, rent divided by price. They work like bond yields. As property prices rise, cap rates tend to fall, as low as 4% in 2007. Now they're averaging 9%. If credit markets don't recover and prices keep dropping, here's what Barry Sternlicht says may happen.
20% cap rates. Real estate goes to unleveraged yields, which are that I'm willing to buy the building at with my remaining capital that I have. And I can get there. I can get to that 20% or 15% return two ways. I can get there all equity, which means the price has to drop by half, or I can get there with some debt and a little bit of equity on top, or 40% equity on top. But I will price to what I need to earn on that building. I don't want to earn a 12% or 8% return because I can go buy commercial mortgage-backed securities and earn 12, AAA, right? I can buy corporate bonds and earn 10%.
We should be afraid of that scenario.
Oh my gosh, yes. I mean, if you take the commercial mortgages outstanding, $3.5 trillion in the U.S. alone, and knock it down to 1.7 trillion, you lose $1.7 trillion.
Yeah, that's a lot of money.
Yeah, especially it's levered 10 to 1 in the banking system. Or the insurance companies have these obligations and they'll be insolvent, every one of them.
Hotels might as well be in Barry Sternlicht's blood. He started the Starwood chain in 1995. He even created the W brand. Sternlicht left that business in 2005 to focus on Starwood Capital, but he's back investing in hotels again. He bought Paris's Crillon, and today he's working on a new project, One, a chain of green hotels he hopes to have up and running by the time the industry pulls out of the current slump.
This is a fun part of what I do. When I came to the industry, you could walk into a room and you couldn't tell the hotel brand. When I left the industry, you knew what a Westin looked like, you knew what a Sheraton looked like, and you knew what a W looked like. You see a picture of them and identify the brand. If you can't tell it apart, it's a commodity. If it's a commodity, you can't price. You just go up and down with the cycle. I was 35 when we started W. I'm a little older now. And I have a couple kids, and I've gotten much more involved in the environmental movement. And I think if you can do good and do green and make money at it, then you have a winning formula. This is the one logo. It tells you something about the brand immediately. It's not just a letter. And you can, you know, the twigs, you can kind of get something different here. It is more expensive to build green today, but the materials keep getting better and prices are getting better. And the hardest part today, there's no financing. The inspiration for this property was pretty specific. I mean, we were going to do something as a greenhouse. So it looks like an English greenhouse on sort of modern steroids. And this is a famous house in Paris that we saw in an article, and I sent our design team led by Kemper hires to go look at. And so we worked with an architect out of Miami to come up with this. We bought the Nigerian embassy across the street from the Ritz-Carlton in Washington. And that's the site, and you can see we've draped the hotel in images of green. I think one of the keys to the interiors will be making sure it's comfortable, which is really the important thing in any hotel, and quiet, and have a good water pressure. I think that there's a customer, just like W, that will pay more for this experience. If we can show people how to live green, and they can do it without sleeping in burlap and without eating carrots, they might actually take it home. So for me, it's like, this works great, but if we use it as a role model of how you can have a great experience and live in a healthy environment and have a carbon neutral footprint and use less power and use less energy, it's just a fabulous thing.
You're getting back into the hotel business. How much worse could it get for those guys?
This is worse than 9/11 for hotels because it's the whole economy and it's global.
Last June, you predicted that it would take, or at least that hotel operators would feel another 18 months of pain. That would take us to the end of this year. Do you think at this point that things might begin to look up by the end of this year, or is that now too optimistic?
Different parts of the hotel market will behave differently, the low end, the high end. But generically, you still see supply. That's got to clear. There won't be many new hotels built. The construction pipelines are cratering, no construction debt available. I think you'll see demand begin to creep up middle of next year, and I think the back half of the year, and that's just a wild guess. I could be totally wrong. We'll see people trade down. So the lower you go, the better you are, probably right now. Until it's chic to spend money again, right now it's the era of inconspicuous consumption. We've gone 180 from where we were. Wealthy people have lost a lot of money. Some of them lost 70% of their net worth, others 50% of their net worth. They still have enough money to go to that resort, 5-star resort in the Caribbean, but they're not going. For lots of reasons, they just don't want to go. And they're driving, and they're going to Vermont, or they're going in California to our Mammoth Mountain. But right now, with your neighbor not having a job and 5 people you know teetering, I mean, you don't want to brag. It's just a different kind of, like, this is the family austerity time. That will change. Americans are very optimistic, and I think they'll get out and they'll go have that nice vacation again. I think the high end will take the longest to come back, shockingly.
We're talking St. Regis, Four Seasons, that kind of thing?
Corporate profits are going to be bad for a while. So demand will come back slower, and the lower ends, I would think, will do better. And this is a good time to watch. Occupancy's down. I just came back from Shanghai and Beijing, and I stayed in beautiful Park Hyatt hotels, magnificent, 35% occupancy in China. You know, we have exposure to places like Paris, and we're working on some projects in the Middle East. I don't know if there's a single hotel market in the world that's up, in the whole world. And the decrease in global trade and what's going to happen in Eastern Europe without credit, I think it's early to make giant bets. I am comforted by replacement cost. You know, and I think global travel is a great business. You're going to have 1 billion+ Chinese and 1 billion+ Indians will become middle class. They will travel. They may travel within their spheres, but they will travel, and they're new, and they create demand. I mean, this is really going to be Brazil, India, Russia. I'm just not sure it's going to be the American decade. They have bigger drivers of growth than we do. But inflation may come back. There's no better asset class in the world to own than hotels. We follow inflation every day. You can buy hotels unbelievably cheaply. And so if you can afford to wait, and then you can make money over the 5-year.
So good to be building, maybe, or thinking about building, good to be in a position to buy, terrible perhaps to be an owner.
If you were to start today, yeah, if you bought the last couple of years, you're not happy. But trophy assets always have buyers, and people buy, like they buy soccer teams, they buy beautiful hotels. And like they buy NFL franchises, they buy hotels. So the Creon has a line from here to the end of the earth of wealthy families who'd like to own it.
Talking to Barry Sternlicht, it's hard not to envision a pretty dismal future for real estate. You've heard him discuss the commercial market, housing prices, the government's relief efforts, and a doomsday scenario even he doesn't want to see. That may be scaring away Sternlicht's competitors, but it's luring new investors to Starwood.
If you think about it, the pension funds are run with models that say you have to put 10% of your fund in real estate. And every time the Dow rallies, all of a sudden that's another $25 billion. And they have to put in real estate. So what happens? Prices go up. Then the stock market drops 50%. I mean, every endowment's worth 27 to 30% less, and some are worth less than that. So they're nervous, and we're in a liquid asset class, and I don't blame them. But this is the best time. And what you see in markets like this, we're seeing high net worth families come out, which is how I started this firm. We're seeing private investors.
Conservative money.
Guys who understand risk and reward, guys who can say, you know, owning the Creon in Paris today is just the most incredible opportunity. I'd never have a chance to buy this if all the other money was back. They want to buy great real estate that they can take a long-term view towards and say, in 20 years, is this going to be worth more than it is worth today? And leave it to their kids. So you're seeing money from Thailand and Pakistan and Switzerland, from families that I've never heard of. We had an asset under contract to an Egyptian family, and I can even find them in the Forbes for 100, but they're going to stroke a 145 million euro pound check. I mean, that's $300 million, and I assure you that's not the only money they have. So this is how, when I started Starwood, I was backed by the Pritzker family, the Ziff family, and the Vanderbilts, the Burden family. And that was the only money we could raise, was private family money, because they saw through the chaos, and they said, oh, there's no one here, we want to be here. And I think that's today. I mean, we're in the market with our new funds, and we love when we get the call on a deal.
Barry Sternlicht thinks he's in pretty good shape. Unlike many of his rivals, Starwood Capital didn't pile on excessive leverage during the bull market. Many of those deals are going bad right now. But Sternlicht will have his day of reckoning in a few years. That's when he'll find out if he started buying too early. For the record, I'm Eric Schatzker.